Here's how the crypto market could grow from $3 trillion all the way up to $100 trillion over the next 5 to 10 years. Plus, about 80% of Americans will end up owning Bitcoin, Ethereum, and a bunch of other cryptos. Big asset managers like BlackRock and Franklin Templeton are starting to move all their products onto the blockchain. And the main public blockchains, those layer ones, will provide the liquidity that lets value flow between private chains and public ones. We've got a ton of other clips to go through, but we're kicking things off with the best ones. Sovereign wealth funds across the Middle East, from Saudi Arabia to Abu Dhabi, Dubai, Bahrain, and Qatar, have a clear mandate focused on AI and blockchain. It's not just about holding Bitcoin as a reserve asset. They're actually building whole parts of their government systems on blockchain technology, like driver's licenses, property deeds, and pretty much everything else. It's pretty wild to watch. A lot of folks tell me that all this money pouring in from these big sovereign players could create some crazy outside returns. But I'm looking at it differently. If we're really going from 3 trillion to 100 trillion by just following the usual growth trend, you naturally need bigger players stepping in as the market gets larger. There's no chance of hitting 15 trillion this cycle without them. So it's not some wild super cycle surprise. It's just what happens when the market size grows. The bigger everything gets, the more these heavy hitters get involved. And as blockchain tech spreads, it pulls in altcoins for all kinds of infrastructure, like new ways to handle computing power, storage, and whatever else is coming down the line. I'm leaning toward a longer cycle overall. The business cycle is still sitting below 50, so it usually takes time to build up. We're also watching the GMI Financial Conditions Index, which tends to lead by about 9 months. With the dollar weakening lately, it points to this possibly stretching all the way into the second quarter of 2026. The whole thing got pushed back because interest rates didn't drop as expected, and the dollar stayed pretty flat for a while. It almost feels more like 2020 than 2021 right now. Or it could be spooky, similar to 2017. A bunch of analysts are calling for the market to start climbing again in April. Guys like Tom Lee and plenty of others think we'll see a spring rally. Who knows what summer will bring, especially if the Clarity Act passes. That could shake things up in ways we can't even guess yet. Are we still stuck on that 4-year cycle, or has it turned into a 5-year one? None of the old patterns included real crypto regulation in the United States with trillions of dollars of investment waiting to flood in. What could that do to the market? Could we finally break free from the usual cycles and just ride one giant super cycle? What do you guys think? Drop your thoughts below. Let's talk about how 80% of Americans are going to hold Bitcoin and Ethereum inside their 401ks. I bet plenty of other cryptos will be in there too. Here's the clip. The head of BlackRock's Retirement Solutions and LifePath team was on, and it looks like there's going to be a huge expansion in what regular people can put into their 401ks. Is that accurate? Yeah, thanks for having me. The new rule is a big step forward for the 401k world. It's not about picking which assets are good or bad. Instead, it sets up a 6-point process that plans have to follow. The goal is to focus more on having solid rules in place and less on worrying about getting sued. You can invest in different things as long as you stick to that process. It won't happen overnight. There's a 60-day comment period now. But think about this. Around 25% of people are in defined benefit plans, while about 80% are in defined contribution plans like 401ks. Right now, those defined benefit plans, used by teachers, firefighters, police officers, and lots of state workers, already have access to these kinds of assets. The rule is basically trying to level the playing field so folks in the private sector with 401ks can get the same options as long as there's a proper process. It's funny how everyone is suddenly talking about leveling the playing field. I think Brad Garlinghouse and the Ripple team kind of started that phrase, and now it's everywhere. King Solomon shared this breaking news. The $1.7 trillion asset manager, Franklin Templeton, is talking about the new world economy built on protocols. They say modern portfolios might end up with 40% in crypto. We're seeing this new economy of protocols where a lot of fresh value is being created, even though plenty of traditional value still lives in the real economy. They're building new kinds of products aimed at people who live in wallet-based systems. For someone coming from a crypto-native background, the old model portfolios of 60% stocks and 40% bonds feel totally out of date. Wallet-based investors might want something way different, like 40% in crypto and 60% spread across public stocks, private equity, public credit, private credit, and government debt. All that government debt needs a home in portfolios now. Plus, new assets that haven't been in traditional investing before but matter culturally, like intellectual property rights for influencers, artists, movies, films, TV shows, and art. Those could become regular parts of investment portfolios. That's the kind of modern model portfolio Franklin Templeton is working on. Can you even picture 40% of a portfolio in crypto? A few years ago, it was 1%, maybe less. Then it jumped to 2%, then 5% announced, and now people are throwing around 10, 20, even 40%. That's huge. Stellar posted this in a chat with someone from Societe Generale Forge and Decentralized at Wallet Connect. Tom Waller shared their secret sauce. It's all happening at once after 12 years of quietly laying the groundwork. Stellar has always stayed focused on the real power of blockchain, giving everyone fair access to the global financial system. They built things like optional controls for issuers and kept their eyes on the main goal without getting distracted by hype around NFTs or meme coins. Standards matter a lot for real adoption, so they put energy into creating those. They also built a distributed, interoperable network for moving money on and off the chain all around the world. One cool part of Stellar is how easy it is to access from anywhere. For example, with MoneyGram, you can walk into any of their 400,000 agent locations worldwide and turn USDC sitting in your Stellar wallet into cash in your hand in the local currency. That's super convenient. Am I the only one who noticed? It looked like they were using pictures from 10 years ago in that clip. The guy definitely seems younger, and the woman's photo didn't quite match up front on. It reminded me of those dating app moments where the picture is from forever ago and then you meet the person. Anyway, random side note. Yesterday on CNBC, Tom Lee said you should be buying the market even if the bottom isn't fully in yet, mainly because he believes the U.S. economy can handle oil at $100 or even $120 a barrel, and oil is getting close to those levels. Would you buy the market right now? Yeah, I think we're 90 to 95% through the sell-off. What makes you so sure? A big part is positioning. Goldman Sachs had a good note about hedge fund activity. They saw a lot of selling that looked like capitulation, so maybe that's mostly done and people can start building positions again. Retail sentiment is really negative too. The AI bulls minus bears reading is down 20, which is a short-term signal. The VIX closed above 30. Earnings season should show companies holding up better than expected. And finally, history shows that stocks tend to bottom early during wartime situations. We've looked back at every war since 1900, and stocks usually hit bottom within the first 10% of the conflict. So if this turns into a 2-year thing, we're probably early in that process. On the tech side, it hasn't been trading well and doesn't seem to be finding any solid ground yet. Memory stocks looked terrible last week, and Micron dropped again today. It doesn't feel like that group, which shot straight up for so long, can find any stability. The big mega cap names haven't looked good either. The only positive thing people say is that their valuations have come down a lot after the pullback. We're in that fire-ready aim phase where any bit of bad news makes people want to reduce risk. But that's also why watching positioning matters. At some point, too many people get too neutral, and then even mildly good news can spark a quick V-shaped bounce. I think the key is taking a longer-term view. There's going to be plenty of ups and downs, especially with things changing every day. If you can zoom out to a 5, 10, or 20-year horizon, things should recover eventually. The stock market has always come back from its worst dips in history, and the same goes for crypto. The tough part for most people is just hanging on until it does. In the last couple of years and looking ahead, we're seeing big jumps in transaction speed on the Ethereum mainnet and other Layer 1 blockchains. Vitalik is basically saying you can't just be a general-purpose Layer 2 anymore. Being fast isn't enough. You need a real edge, like strong privacy features or focusing on a specific asset class or serving institutions. Just being another generic fast chain won't cut it. That said, there will still be other Layer 1s, and a bunch are coming for the Ethereum ecosystem. But when it comes to the finality and rock-solid economic security that finance needs, that's going to stay on Ethereum. Other chains might shine for meme coins, gaming, or stuff that doesn't need as much security. The speed advantage is coming to the Ethereum mainnet too, so it'll be both secure and super high throughput. We'll probably challenge some of the Layer 2s unless they specialize in something unique. Just to be clear, the person saying this has a big financial interest in Ethereum doing well, so their take isn't totally neutral. They're the CEO of a company heavily invested in Ethereum. There's a reason companies like Robinhood and Coinbase built on Ethereum. They wanted that built-in security, and Ethereum got kind of a free pass years ago. It's easy to see why. If XRP hadn't been dragged into that lawsuit and the SEC hadn't basically picked winners by giving Ethereum special treatment, things might look different. We never really got a full explanation for how Ethereum got that pass or what went on behind the scenes. It's frustrating that some projects got the easy route while others didn't, but that's life sometimes. There's a lot happening at the consensus event covering all this stuff. At the end of the day, these big banks are competitors too. If they start moving into on-chain trading and their positions become fully visible and traceable, that could stop them from jumping in. Imagine Goldman Sachs and JP Morgan both holding positions but not wanting the other side of the trade to know exactly where they stand. With new privacy technology, they'll be able to keep those positions private so competitors can't see their books. And then there's this other clip I'll save for later. For a lot of investors around the world, they don't even have a choice. They can't easily buy ETFs through a regular brokerage, or they face high fees and big minimums. Tokenization changes that by bringing ETFs straight to hundreds of millions of people who use wallets. It also adds 24/7 trading and instant settlement. These tokenized assets are fully backed, remote, and open to anyone. That lets you use them inside DeFi, which creates brand new ways to get value from them. For example, you could borrow against your tokenized SPY or tokenized Tesla shares. Stablecoins were the first step into this on-chain economy. Once people get comfortable holding a dollar-pegged stablecoin in their wallet, the next thing they want is yield. That's why tokenized treasuries came first. 6 months ago, we launched our tokenized equity and ETF platform, and the demand has been strong. We just hit over $700 million in total value locked, while the whole industry sits around $1 billion. I see two huge growth drivers ahead. First, the massive generational wealth transfer as baby boomers move trillions out of traditional 60/40 portfolios into the hands of more crypto-native people. Second, AI agents. An AI can't walk into a bank and open an account, but it can easily manage a crypto wallet and automatically rebalance your holdings. Those two things together should really expand the whole space. Those were the latest clips from X that I wanted to share with you. Make sure you're subscribed, hit like if it helped, and let me know what you think about any of it. Thanks for hanging out here for your crypto updates. It's awesome to have you. See you next time.